This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. Most beginners are great at spotting when to buy and terrible at knowing when to get out. They ride a winner all the way up, watching their profit grow, feeling confident, feeling smart, and then the market quietly rolls over. The gains shrink. They hold on hoping it bounces. It doesn't. And just like that, a winning trade becomes a losing one. Sound familiar? Here's the truth. The market almost always warns you before it drops. It doesn't just reverse out of nowhere. It leaves footprints, specific candlestick patterns that show up right at the top, right before the fall. The problem is, most traders either don't know what to look for, or they see these patterns everywhere and trade them in the wrong spot, which is just as bad. In this lesson, I'll show you the 5 bearish reversal patterns that actually matter, and more importantly, the exact spot on the chart where they mean something. Because the same pattern in the wrong place is just noise. 5 patterns, one rule that ties them all together. Let's get into it. Before we touch a single pattern, I need you to understand this one rule, because it's what separates people who make money from people who just memorize shapes and wonder why they keep losing. Here it is. A bearish reversal pattern only matters at the top of a move, at resistance. Let me say that again. At the top of a move, at resistance. If you see one of these patterns in the middle of nowhere, with price just chopping sideways, ignore it. It means nothing there. But if you see it where price has already run up a long way, where the trend is extended, where buyers are exhausted, or right at a level where price got rejected before, now you're paying attention. Now you have context. Now the pattern actually means something. This is what we call confluence, and it's the difference between guessing and trading with an edge. So every pattern I show you today, I'm not just going to tell you what it looks like. I'm going to show you where it counts and where it doesn't. Keep that in your head for the rest of this video. Pattern 1. The shooting star. Picture a candle with a small body near the bottom, little to no lower wick, and a long wick sticking straight up. That long upper wick is the entire story. What happened during that session? Buyers pushed price way up. They were aggressive. They were confident. It looked like the move was going to continue. And then sellers came in hard and slammed price all the way back down before the close. That's rejection. Buyers tried to push higher, and they failed. The longer that upper wick, the more dramatic the rejection. Now, where does a shooting star actually work? At the top of an uptrend, or right at a resistance level, a price where the market has been rejected before. Imagine price has been climbing for 5 or 6 sessions in a row, and then right at that old resistance level, you get a shooting star. That's a meaningful signal. A shooting star in the middle of a sideways range? That's noise. How to trade it? Your entry is on the break of the shooting star's low, meaning you wait for the next candle to break below the bottom of the shooting star before you enter. Your stop loss goes just above the top of that long upper wick, because if price climbs back above it, your reversal idea is wrong and you want to be out. For your target, aim for at least twice your risk or the nearest support level below. That way, even if you're only right half the time, you still come out ahead. Pattern 2. The bearish engulfing. This is a 2-candle pattern, and it's one of the most visually clear signals you'll ever see on a chart. Here's how it works. First, you have a small green up candle. Nothing special, just a normal day where buyers were in control. Then the very next session, a big red candle appears, and this red candle doesn't just go down, it completely swallows the previous green candle. It opens higher than the green candle's close, and it closes lower than the green candle's open. The entire previous day's buying has been erased in one session. Think about what that means. Sellers didn't just show up. They overwhelmed the buyers so completely that they erased an entire day of progress. That's a power shift. That's sellers saying, we're in control now, where it works best. The bigger the engulfing candle relative to the previous candle, the stronger the signal. And like every pattern on this list, it's most meaningful at resistance or after an extended run-up. If price has been trending up for 2 weeks and then you get a bearish engulfing right at a resistance level, that's a high probability setup. If you see the same pattern in the middle of choppy price action, it doesn't carry nearly the same weight. How to trade it? Entry on the close of the engulfing candle, or you can wait for the break of its low for extra confirmation. Stop goes above the high of the engulfing candle. Target 2 times your risk or the nearest prior support level. Quick pause. If you're leveling up your trading, you're probably leveling up other areas of life too. If you need a clean, professional resume fast, check out ResumeZenith, link in the description. And if this is helping, do me one favor. Hit subscribe and the bell so you don't miss the next lesson. It's free, and it tells me to keep making these. Back to it. Pattern 3, the Evening Star. This is probably the most reliable pattern on this entire list, and it's made up of 3 candles. Let me walk you through each one. Candle 1, a strong green candle. Buyers are clearly in control, the trend is pushing higher, everything looks bullish. Candle 2, a small-bodied candle. Could be green, could be red, doesn't matter. What matters is that the body is small. After that big, confident green candle, the market suddenly stalls. This small candle represents indecision. The momentum is dying. Buyers and sellers are fighting to a standstill at the top. And then candle 3, a big red candle that drops back down into the body of the first green candle. The reversal is confirmed. Sellers have taken over. Think of it like a sunset. The strong green candle is the bright afternoon. The small middle candle is the sky turning orange. And the big red candle is darkness falling. The trend's day is ending. Where it works, at the peak of an uptrend, especially at a resistance level, that little middle candle is your early warning. When you see momentum stall like that at the top, pay close attention to what comes next. How to trade it. Entry on the break of the third candle's low. Stop above the high of that small middle candle. Target 2 times risk or the next significant support zone below. Pattern 4, the Hanging Man. This is one of the most misunderstood patterns in technical analysis because it looks identical to a pattern you already know. Small body near the top, long lower wick, little to no upper wick. If you watched Lesson 3, you'll recognize this shape immediately. It's a hammer. But here's the critical difference. And this is the perfect example of why location is everything in candlestick trading. A hammer appears at the bottom of a downtrend. It's bullish. It means buyers stepped in and pushed price back up from the lows. Same exact shape. But the hanging man appears at the top of an uptrend. And at the top, that same long lower wick tells a completely different story. It means that during the session, sellers pushed price down significantly. Yes, buyers recovered by the close. But the fact that sellers were able to push price down that far in the middle of an uptrend is the first crack in the armor. It's a warning that the trend might be losing steam. Same candle, same shape, opposite meaning. All because of where it appears on the chart, where it works, only at the top of an uptrend, after an extended move higher. How to trade it. This one needs confirmation more than the others. Wait for a red candle the next session. If that next candle closes lower, then you enter on the break of the hanging man's low. Stop above the hanging man's high. Target 2 times risk. Pattern 5, dark cloud cover. 2 candles, and this one has a psychological element that makes it especially powerful. Here's the setup. First, you have a strong green candle. Buyers are in control. The uptrend looks healthy. Everything points higher. Then the next session opens, and it opens above the previous green candle's high. At the open, this looks even more bullish. Traders who bought the first green candle are feeling great. New buyers are jumping in, and then, throughout the session, sellers take over. Price falls, and by the close, the red candle has closed past the halfway point of that green candle's body. What just happened? Every single person who bought at the open of that second candle is now underwater. They're sitting on a loss, and that creates selling pressure because those trapped buyers start exiting their positions. That's what fuels the drop that often follows a dark cloud cover. Where it works, at resistance, or after a strong sustained up move. The deeper the red candle closes into the green one, the stronger the signal. If it barely reaches the midpoint, it's a weaker signal. If it closes well past it, that's a strong dark cloud cover. How to trade it. Entry on the break of the red candle's low. Stop above the red candle's high. Target 2 times risk or the nearest support level. Here's what ties all 5 patterns together, and honestly, this might be the most important part of the entire lesson. It's the part that 99% of beginners skip, and it's the reason they keep losing money even when they correctly identify the pattern. A pattern by itself is a maybe. It's a clue, not a verdict. But a pattern at resistance, after a strong run-up with a clean, obvious formation, that's a setup. That's when these patterns go from textbook shapes to actual trading opportunities. So here's your checklist. Before you ever act on any of these 5 patterns, ask yourself 3 questions. 1. Has price run up a lot already? Is the trend extended? Because a reversal can only happen if there's actually something to reverse. 2. Is it at a level where price got rejected before? A resistance level, a previous high, a trend line? If the pattern forms at a meaningful level, it carries 10 times more weight. 3. Is the pattern clean and obvious? If you have to squint to see it, if you have to convince yourself it's there, it's probably not there. The best patterns jump off the chart. If you get all 3 of those factors lining up, that's confluence, and that's when these patterns actually pay. Your homework. And I want you to actually do this, because reading about patterns is one thing, but spotting them in the wild is where the real learning happens. Pull up any chart on TradingView, it's free, switch to the daily time frame, and scroll through the chart looking for just one of these 5 patterns at the top of a move, not at the bottom, not in the middle, at the top. And when you find one, look at what happened next. Did price drop? How far did it go? Where would your stop have been? Where would your target have been? Just observe. Don't trade it. Just train your eyes to spot it. Do this with 5 different charts, and I promise you, by the end of the exercise, you'll start seeing these patterns everywhere. And to make all of this easy to reference later, I put everything from this lesson, all 5 patterns, where they work, the exact entry, stop loss, and target rules, into a free cheat sheet. Just drop your email at candlelogictrading.com and I'll send it straight to you. It's the kind of thing you can pull up on your phone while you're looking at charts. Next lesson, we leave individual patterns behind and zoom out. We're going to learn how to read market structure, trends, ranges, and the choppy in between. Because knowing a pattern is bearish doesn't help much if you don't know whether the overall market is trending up, trending down, or going nowhere. That's lesson 5, and it's going to change how you look at every chart. New lessons drop every Sunday, Tuesday, and Thursday. Like, subscribe, hit the bell, and I'll see you in the next one. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.